This is a pre-lecture video on development accounting for the course Global Business Economics. I'm David Frankel, a professor at Melbourne Business School. Let's get started. To study how an economy produces output, economists use an aggregate production function. In such a function, output y is written in terms of several key variables and parameters. We will use the function that is depicted, which is called a Cobb-Douglas function. The term K on the right-hand side denotes the economy's physical capital, the stock of machines and buildings that are available for production. To capture its relative importance, physical capital K is raised to a power alpha that lies between 0 and 1. Alpha is interpreted as the share of national income that goes to physical capital and is usually estimated at about 0.4. The next part of the function is the product of two terms, human capital H, which captures the marketable skills of the typical worker, and labor hours L, which is the total number of labor hours worked in the economy. The product HL is known as effective labor, total labor hours adjusted for the effectiveness of labor as measured by human capital. To capture its relative importance, effective labor is raised to the power 1 minus alpha, which is the share of national income that goes to labor. The final term on the right-hand side, denoted by the letter A, is total factor productivity, or TFP. It captures everything that affects output Y other than physical capital K and effective labor HL. In a different pre-lecture video, titled Growth Accounting, we study the determinants of growth rates, the percentage increases in output and other variables from one year to the next. Those tools let us answer questions like, why has country A grown faster than country B? However, sometimes growth rates are not enough. For instance, we might want to know why country A's labor productivity, despite having grown relatively quickly, still lags far behind that of country B. In this video, we will learn about a new tool to study why the levels of economic variables vary across countries. This tool is called development accounting. While powerful and informative, this tool does have a couple of limitations. First, it focuses exclusively on labor productivity, output Y per labor hour L. That is, development accounting studies why workers are more productive in some countries than in others. Second, it requires data on human capital H. For some countries and time periods, such data are unavailable. With those caveats, we begin with the Cobb-Douglas production function, which we write here as equation 1. It states that output Y is the product of total factor productivity A, physical capital K to the power alpha, and effective labor HL to the power 1 minus alpha. We now introduce a useful mathematical rule, equation 2, which states that x to the power A times z to the power B, all raised to the power C, equals x to the AC times z to the BC. Furthermore, equation 3 states that 1 plus the ratio of alpha to 1 minus alpha equals the ratio of 1 to 1 minus alpha. To see this, one can easily check that each expression equals the ratio of 1 minus alpha plus alpha to 1 minus alpha. Armed with these tools, we can now derive the basic development accounting formula. First, since the two sides of equation 3 are equal, we can obtain another equality by raising output Y to either side of equation 3. The next step is to replace output Y in the right side expression with the Cobb-Douglas production function given in equation 1. We next use equation 2 to combine the exponents inside the square brackets with the exponent that is outside. This amounts to dividing each exponent inside the square brackets by 1 minus alpha. We then simplify the result by noting that the exponent on effective labor HL equals 1. Next, we divide the first and last terms by the product of L and y raised to the power alpha over 1 minus alpha. Canceling terms that appear in both numerator and denominator, we obtain our final equation. This equation, reproduced here, is our key takeaway. It states that the level, not the growth rate, of labor productivity is the product of three terms. The first, denoted TFP star, equals TFPA raised to the power of 1 over 1 minus alpha. Since the exponent is positive, TFP star is simply an increasing function of TFPA. The second term, which we refer to as capital intensity, is the capital output ratio K over Y raised to the power alpha over 1 minus alpha. This exponent is positive as well. Thus, capital intensity is an increasing function of the capital output ratio K over Y. The final term is simply human capital H. In practice, the three components tend to move more or less independently of one another. Each thus provides independent information about why one country's workers are more or less productive than another's. One feature of development accounting that is not present in growth accounting is the capital intensity term. What drives it? Economists believe that it is driven mainly by a country's investment rate, the proportion of its output that is used to buy new physical capital. Countries that have higher investment rates tend to have a higher capital intensity. But what leads to a high investment rate? There are a couple of key factors. The first is the tax rate on investment income, on dividends, interest, rents, and so on. Lower investment tax rates lead to a higher investment rate and thus to higher capital intensity. The second factor is low and stable interest rates. This is because a firm's incentive to invest is stronger when interest rates are low and expected to remain so for a long time. To keep interest rates low, two conditions are generally needed. The first is low inflation. High inflation countries, in contrast, must frequently raise interest rates to prevent inflation from getting out of control. The second is a strong credit rating of the government. This lets the country borrow without having to pay high interest rates. With these conditions in place, a country's firms will invest more in physical capital. In the long run, such investments will raise the country's capital intensity and thus also its labor productivity. This concludes the GBE pre-lecture video on development accounting. Thank you for watching.